Hey everyone, welcome back to Corporate Decoder. Today we are diving into American Clean Resources Group Inc.'s latest financial report that for the 6 months ending June 2025, their financials look like a penny stocks fever dream. So let's see what the numbers really tell us. And if you're liking these deep dives into corporate filings, make sure you're subscribed and join our Discord community linked in the description below. You get more exclusive content and discussions. This report is a quarterly update, giving us a peek into how the company is doing financially during those 6 months. For American Clean Resources Group Inc., it's definitely a story of operations that are still revving up and very much in an exploration stage. Let's start with the balance sheet as of June 30, 2025. This is like a snapshot of what the company owns and owes. On the asset side, they have mineral rights valued at over $3.8 million. That's a significant chunk of their assets. But look at their cash, it's only $84.45. That's very low. Now let's look at liabilities. Their total current liabilities are over $5 million. This includes things like accounts payable and accrued interest. This means they owe more money than they have readily available in cash, which can sometimes be a red flag for immediate financial health. And then there's the stockholders deficit, which is a negative number, over $11 million. This basically means that the value of what the company owes is more than the value of everything it owns, considering the money shareholders have put in. It's a tough spot to be in. Now, let's look at how they performed in terms of making and losing money. For the 3 months ending June 30, 2025, they had a net loss of over $355,000. And for the 6 months ending June 30, 2025, that net loss jumps up to over $753,000. They aren't bringing in any revenue yet from their main business of custom processing. So all these expenses are piling up. General and administrative expenses are a big part of this, coming in at over $500,000 for the 6-month period. Looking at cash flow is crucial. For the 6 months ending June 30, 2025, they used over $503,000 in operating activities, but they did get over $511,000 from financing activities, mostly from related parties. This means they are relying on borrowing money or getting investments to keep the lights on because their day-to-day business isn't generating positive cash flow yet. The notes to the financial statements are where the real story often is. Take a look at this section under Going Concern. It explicitly states that the company has recurring losses and a significant accumulated deficit, which raises substantial doubt about its ability to continue as a going concern for the next 12 months. This is a serious warning sign directly from the company itself. They are saying they might not be able to stay in business without getting more money soon, either through loans or selling more shares. Something else that pops out is this mention of restating previously issued financial statements. This means that some of the numbers they reported before were wrong, leading them to correct the record. It's not ideal and can sometimes indicate issues with financial reporting accuracy. Scroll convertible to promissory notes payable to a related party. Now let's dive into their debt. A big piece of their financing comes from Granite Peak Resources LLC, or GPR, which is a related party and their majority shareholder. They have a line of credit with GPR that's grown quite a bit. As of June 30, 2025, the outstanding balance, including principal and interest, is over $90,000. This shows a heavy reliance on this related party for funding. They also mention consolidating previous debts and judgments into this line of credit, which is typical for companies trying to simplify their financial structure, but also highlights the amount of debt they've been dealing with. They detail how GPR acquired several old debts and even a court judgment against the company. These were then rolled into the line of credit with GPR. For example, the Stephen Fleckner judgment of over $2 million plus accrued interest was consolidated. It's a lot of history being brought under one umbrella, showing the company's past financial struggles. The company clearly relies heavily on GPR, not only for loans, but also GPR has paid expenses directly for the company. This is common for a majority shareholder supporting a struggling business, but it also means GPR has significant control and influence. It also states GPR owns about 73% of the company, which is a huge stake. There's talk of a potential merger with Sustainable Metal Solutions LLC or SMS Group. This would involve meeting several conditions like getting audited financials for SMS, a technical report on their mineral reserves, and uplisting ACRG stock to NASDAQ. These are major steps that, if achieved, could be very positive for the company, but they are also significant hurdles. Interestingly, the company views its operations in just one segment, mining gold and silver from their Tonopah property. This simplifies things, but also means their entire focus is on this one area, making any issues there directly impact the whole company. In their management's discussion and analysis, they include a forward-looking statement warning about risks. They highlight that actual results could differ significantly and mention various risks like macroeconomic conditions, geopolitical tensions, and their ability to develop and commercialize products. This is standard but reinforces the uncertainty surrounding their future. They explain that general and administrative expenses decreased for the 3-month period compared to the prior year, largely because amortization expense for a previously written off technology was gone. However, they anticipate these expenses will increase as they work toward that planned merger was gone. This section reiterates the going concern issue. With current assets less than current liabilities and ongoing operating losses, the need for external financing is critical. They state they don't currently generate positive operating cash flows and are relying on GPR, potential equity, and third-party debt. Here's a big one for the geeks among us. They admit that their disclosure controls and procedures are not effective as of June 30, 2025. They point out material weaknesses in internal control over financial reporting. These weaknesses include entering into material transactions without proper documentation or board approval in the past, a lack of evidence for review of account reconciliations and journal entries due to insufficient personnel and expertise, and delays in financial data review due to management and officer changes. They are taking steps to fix these, but acknowledge that limited funds might restrict how effective these changes can be. Now, looking at these results more broadly, American Clean Resources Group, Inc. is very much an exploration stage company. Their biggest strength is their retained mineral rights, which represent a potential future value. However, their weaknesses are glaring. The massive accumulated deficit, the very low cash balance, the reliance on a single related party for significant funding, and the admitted material weaknesses in internal financial controls paint a picture of a company still building its foundation from the ground up and facing significant risks as highlighted by their own management. In the going concern note, it's a high risk, high reward situation, heavily leaning towards the risk side. Right now, without revenue generation. Alright, that's our breakdown of American Clean Resources Group's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.